I'd also like to thank my co-presenters, Marty Shankman, Steve Horowitz, as well as our audience for joining us. We know that you have many webinar choices, so thank you for giving us your time. With that, let me tell you that my objective for this next half hour is to just basically make you aware of the 4 living benefit strategies of life insurance policies that most of your clients are absolutely unaware of, and many of you may not be aware of yourselves. So let's start with the agenda. So what I'm going to be talking about are what are living benefits of life insurance policy. And part of that, as far as I'm concerned, is matching and selecting the death benefit or living benefit, because policies have both. I'll talk about an overview of the 6 types of life insurance policies, and also talk about the overview of the long-term care industry, because the long-term care insurance industry, I should say, because that did drive 2 of the living benefits that I'll be talking about. Be talking about the Pension Protection Act, which invited the long-term care industry and the annuity industry to take advantage of some of the living benefits. The 4 benefits are being able to pay for long-term care expenses from the death benefit of the policy, tax-free. Also be talking about the ability to transfer life insurance gains to long-term care or an annuity, also tax-free, basically similar to 1035 or 1031 exchange, and the ability for the insured owner to sell a life insurance policy. The last living benefit is using tax deferral to be able to supplement one's retirement. So first choice is death benefit or living benefit. Well, everybody's aware of the traditional death benefits of life insurance policies, providing family income, paying off debts, future liabilities, some future tax liabilities created as a result of the Secure Act, which is another subject altogether. Being able to talk about providing an educational fund for our children, and also funding buy-sell agreements for business partners. That's what we're not going to be talking about. What we are going to be talking about are the living benefits of paying for long-term care costs from the death benefit of an insurance policy, a tax-free exchange into a long-term care policy from life insurance and or an annuity, as well as being able to sell a policy that benefits the insured while he or she is alive, and lastly, to be able to supplement retirement with tax advantage payouts. So how many times do people buy a life insurance policy during the course of a typical lifestyle? Well, when they buy a house, when they have a child, when they have a second child, or have a bigger house, a bigger mortgage, if they start a business or apply for a loan, if they have a business partner, having a buy-sell agreement, and basically if and when they want to create a legacy for the next generation using life insurance. And lastly, if they want to prepay their federal, state, or inheritance taxes. Three actually in yellow are the living benefits, where they make their first appearance. And that's when people want to set up a supplemental retirement plan to supplement their retirement, or when they want to use life insurance to pay for long-term care costs. This is not when they buy life insurance, but the third area that we'll talk about is when they want to sell their policy for cash today. So life insurance is an asset class. Most people aren't aware of the living benefits because they don't use their life insurance to pay for long-term care expenses. Most people surrender or lapse their life insurance coverage when they no longer want it or when they no longer can afford it. They don't necessarily think of selling it. Most clients don't use tax-deferred benefits of a life insurance policy to supplement their retirement. Most people use stocks, bonds. This is an interesting spot to be able to diversify a little bit further. And most clients don't transfer the life or annuity gains into a long-term care policy. They just basically pay the taxes on their annuity gains, and that's the end of it. And most clients really pay very little attention to this asset class compared to their stock, bond, or real estate portfolio. So, being able to match a policy with clients' objectives. There are 6 policies, and what I'm going to do is very briefly go through those that provide a living benefit, and I'll just mention those that provide a death benefit. Term life insurance, most popular life insurance product to maximize the death benefit. It's also the least expensive. Why is it the least expensive? Because only 2% of term policies ever get paid out. Why is that? Because term policies basically end anywhere between age 80 and age 82. And a term policy has a few guaranteed items. What are those guaranteed items? One, the death benefit is guaranteed. Two, the premium is guaranteed. And three, the duration of how long that coverage lasts is also guaranteed. Term insurance can be purchased either on an individual basis or on a group association term basis. Individual term policies can be converted, transferred if you leave your place of employment. However, group association term policies are a ticking time bomb waiting to happen. And I know that most of you have some form of a group term association through the ABA, through the New York State Bar Association, whatever the case may be. If you have a group association policy, you might want to request a particular article that I'd written on the subject. Term insurance is not for accumulation. Whole life insurance is the second. Whole life insurance has been the workhorse of the industry for the last 180 years. Policy accumulates cash value, provides the least amount of death benefit for the maximum premium that you're paying. It's a good conservative product for accumulation. And when I talk about cash value, I just need to take a moment just to explain what cash value is. For example, person pays a $10,000 premium. There are expenses, administrative expenses, fees, medical costs to underwrite the policy, commissions. So let's assume that it's $3,000. $10,000 minus the $3,000 administrative costs leaves approximately $7,000. In a term policy, most term policies guarantee in the vicinity of a 3% payout. So that $7,000 each and every year will grow by 3% guaranteed, on and on and on, so on and so forth. Next policy type is something called an indexed universal. A little bit different. It doesn't have a guaranteed return basis. Instead, it gives you the option of picking a specific stock index that you choose. And then on this particular type of contract, in exchange for caps of, say, 75% of your gains, if there's a loss, you don't suffer a loss. So the returns won't decrease if the stock index that you chose declines. It's an excellent vehicle for maximum death benefits, for accumulation and distribution planning. And again, what does the cash value look like in a index product? Same $10,000 premium, same $3,000 expenses, leave $7,000, but the cash value growth is dependent on the specific stock index that you have chosen. In this particular policy, 75% of the gains and 0% of the losses. Variable universal policy works somewhat similar, only there are no guarantees. The client assumes 100% of the market risk. It's an excellent vehicle for someone who wants to put more money into a policy than they need to, because the overfunded policy accumulates tax deferred, and then it can be distributed tax-free in terms of tax-free planning. It's a wonderful product for people wishing to assume and obtain a high rate of return. Private placement, who we'll hear from Steve in a little bit, is basically similar to a variable universal, but it's basically used for the ultra and for the high net worth client to overfund and accumulate funds at a specifically lower cost. And Steve will touch on that a little bit further down the road. The fifth type policy is a non-guaranteed universal, which currently makes up about 55 to 60% of the marketplace. It's the only option to be able to pay less than whole life and yet still have permanent coverage. The non-guaranteed product, ever since it came into being, non-guaranteed universal product, ever since it came into being in the early 80s, has really been one of the significant workhorses of the insurance industry for the last 20 some odd years. I should say for the last 40 some odd years. People assume that the interest rates on these contracts would remain constant. And if you recall, back in the 80s, we had interest rates as high as 21%. So most policies were purchased years ago when the interest rates were significantly higher. And as the interest rates decreased, people should have increased the premiums, but no one told them. And they should have paid a higher premium, but they didn't. And as a result, many policies today are increasingly expiring prematurely. And we'll talk about that in a few moments, a little bit more in detail. The sixth option is something that came about in 2003, and that is a guaranteed universal. When the industry was sick and tired of hearing complaints coming in from people who had policies that heretofore they didn't realize were non-guaranteed, the insurance industry finally began offering a guaranteed universal. It's a wonderful product, and today, over the last 20 years, that has basically been the current workhorse of the insurance industry, to be able to provide minimum accumulation as the insured assumes zero risk, and the death benefit and the premium and the death benefit, the premium, and the duration are all guaranteed. Okay, so a word about long-term care today. It's one of the fastest growing group benefits for employers and employees. It provides tax benefits, it provides tax credits, and it provides discounts. It also, of course, provides the independence that an individual has and the peace of mind they have for having one of these policies. The benefits can be discriminatory, and people want the benefit, but they basically consider the costs too expensive. And as a result of that, the industry basically got a bad reputation, which was as a result of some incorrect pricing assumptions, because the underwriters and the actuaries, I should say, had no clue how to deal with this. It was brand new. So they went ahead and they began using some incorrect utilization assumptions. They thought that far fewer people would use this. They thought that people would be giving these policies up at the end of 5 or 10 years, similar to what they do with life insurance. They also assumed that the interest rates would stay much higher. Well, this led to significant premium increases, and it led to consumers' fear to purchase. And it didn't address the consumer's major concern. If I don't use this stuff, I'll lose it. And that basically resulted in only a 9% penetration into the marketplace. Well, the insurance industry is not a stupid industry. So what they did is they collaborated with the government. And the insurance industry decided to increase private ownership of long-term care insurance benefits. Why? Because it accomplished two things. It provided consumers with the price guarantees against rate increases, and it also provided the insurers profitability, because if more people would have this coverage, the insurance industry would make more money. It was also good for the government because it reduced individuals relying on government Medicaid costs. So for the first time, as a result of the Pension Protection Act, for the first time, it allowed what they call linked or combination or hybrid life insurance policies to pay long-term care costs directly from the death benefit on a tax-free basis. It also allowed for tax-free transfers from life insurance and annuities to pay for long-term care costs. And most importantly, if an individual didn't use the benefit during the course of his or her lifetime, then the beneficiaries would receive the death benefit. So, to summarize for a moment, the Pension Protection Act allows tax-free exchanges on the gains. Trillions of dollars of annuities out there. On the left side of the screen, if an individual had a $50,000 annuity and had a gain of $50,000, they would first have to pay tax of approximately $20,000, 30%, on that $50,000 gain, leaving an availability of only $80,000. However, after the Pension Protection Act, that same individual with a $50,000 basis and a $50,000 gain, well, if that $50,000 gain is used for long-term care, then that $50,000 gain is not taxable, providing the entire $100,000. And this can be transferred to a long-term care contract today, which benefits the insured today. Just the schematic on the left side, you'll notice that there is no long-term care options. On the right side, the 1035 exchange rules now allow an annuity to go into long-term care, a life insurance to go into long-term care, and a qualified long-term care, which is not the name. This is the schematic for the gains on the annuities. Keep in mind, trillions of dollars of annuities being held by your clients, and most of them are using it for the wrong reasons, because when it's the end of the day, beneficiaries, before they receive the benefit, they're first going to be paying taxes. How does the total living coverage work? Very simply, somebody puts in a $100,000 premium, somebody gets a $159,000 death benefit, or they can wind up turning that $100,000 into an almost $500,000 long-term care benefit, providing basically $6,000 a month for 6 years. That's just on the 100,000. Okay, as I mentioned, there are two types of long-term care coverages. One is the traditional, where a person pays the premium on an individual on an annualized basis, using a typical example of, say, $200 a day for 3 years plus inflation for a female 65. This is the use it or lose it option. The annual cost is approximately $3,200, less discounts, deductions, and credits. This is just $3,200 is the gross premium. Please keep in mind that there's a 20% New York State tax credit for anyone purchasing a traditional long-term care policy. So in 20 years, that $200 a day becomes $500,000 with inflation, and it's $500,000 is available to pay claims. The other side of that coin is the same individual could have purchased a $500,000 life insurance policy called a linked or combo or hybrid for that same female 65. That cost would be approximately $6,200. So individual can just do the math and figure out whether it makes sense for him or her to have the traditional policy or to have the combo policy. Combo policy costs approximately $3,000. Is it worth $3,000 annually for a female 65 to purchase a $500,000 policy? I think yes. But again, it depends on the ages, and it depends on you and your client, and of course, client's health. So what to do with an unwanted policy? Life insurance becomes too expensive because non-guaranteed universal life policies have been neglected. So when a policy is no longer needed or no longer able to be afforded, and as an example of that, mortgages are paid off, buy-sell insurance is no longer needed, or when state taxes are no longer an issue, people look at their life insurance and they say, why is my life insurance increasing or decreasing in the duration? Or why am I getting a letter from the insurance company telling me that I have to pay twice as much? Well, the reason is very simply, most people were not aware that the life insurance policy, the non-guaranteed policies, were non-guaranteed. It was just considered universal life insurance, and people assumed life insurance would be guaranteed, just like term insurance was, just like whole life was. That's not the case. It's the trustee's responsibility to manage the policy, not the agents, not the insurers. People should have increased the premiums, but they didn't know that they should have. They treated life insurance as a buy and hold asset, basically putting it in the bottom left-hand drawer and then letting it sit there and not looking at it until they got that letter from the insurance company saying that you need to pay a higher premium or your policy will be expiring within the course of XYZ. So as a result of reduced interest rates, coverage today is expiring prematurely. Very briefly, the Wall Street Journal, I've contacted Wall Street Journal several times over the years, letting them know that it's a problem. Wall Street Journal has run several stories, and they basically say, yes, people's life insurance is expiring prematurely for the various reasons on the slide. The insurance industry is finally acknowledging that there's a problem, and this is from General Counsel for the Insurance Marketplace Standards Association, saying, while the insurance industry hasn't publicized the issue, there is a growing concern of the industry about lapsing universal life policies. That should have been on the front page of the Wall Street Journal. So if there's a problem with a policy, client needs to obtain, or a agent for the client needs to obtain, an annual summary statement, historic projection, and engage an independent broker to obtain and to evaluate that information. Client's options are to reduce the face amount, to pay a higher premium, if possible, obtain a new guaranteed contract if they're qualified, if their health allows it, or to be able to sell the life policy as a life settlement to an institutional investor or some combination of the above. So most people, when the coverage is no longer needed or wanted, they either keep the coverage till the cash value runs out and the coverage runs out, or some people surrender the policy for the remaining cash value from the insurance company. But a far better alternative for somebody over age 70 and for somebody in standard health with a policy of at least 100,000 is to be able to sell the policy. Again, Oliver Wendell Holmes U.S. Supreme Court Justice in Grigsby versus Russell, placed the ownership of life insurance same as you would for a car, a home, boat, or any other piece of property available to be sold. So how do you turn a bill into an asset? Example, in this particular situation, male, age 86, had an $800,000 policy with a $26,000 premium. Insured borrowed 100% of the cash value, also borrowed the dividends to pay the premiums. And now the insured had a $52,000 taxable gain, and the coverage was set to expire at age 87 next year. Following year, his premium would have increased to $29,000, and then it would have been increasing 4 to 5% each and every year. So after an initial consult, the client was informed that a life settlement is an option. We ordered the life expectancy reports to try to figure out how long this individual would remain alive for. Sounds gruesome, but that's the way the life settlement industry works. A life settlement offer was obtained from an institutional investor, and the client wound up accepting $188,000 life settlement cash, plus he was able to stop paying the premium, plus he still had the life insurance, the residual life insurance, I shouldn't say the residual, the life insurance over all of those years. Had he passed, the beneficiaries would have received $800,000. So basically, a life settlement is an alternate exit strategy. When the benefit is no longer needed, again, tax is no longer needed, businesses are sold, or buy-sell is no longer required. When business loan is paid off. Another recent example is a client had 3 children, and he didn't want to wait until he asked those children to receive a gift from him. So the client was aged 82. He had a $5 million death benefit, and his cash value was $1.3 million. Fortunately, his attorney referred him to me before he turned in the policy for cash value from the insurance company, and the client wound up accepting a $1.8 million cash offer, basically $500,000 more than he would have received had he turned that policy in for its cash value. Some new information on life settlement. Yes, an individual does have to be over age 70. Yes, the declining health is preferred. 100,000 is a base. Term insurance can also be converted if it's not past the conversion age, and that's an important point. Usually age 65, 70, life insurance policies can be converted from a term policy into a permanent policy. Now there's a new market for any type of guaranteed universal policy. If anyone has a guaranteed universal policy, a life settlement institutional investor will purchase that policy, regardless of the individual's health. Even if he or she is in excellent health, they figure that if it was good enough for an insurance company to provide them the coverage, then it would also make sense for the life settlement institutional investor to purchase that coverage. Supplemental executive retirement plans is the 4th living benefit, and it allows for personal accumulation strategies using either the whole life, the index universal life, the variable universal, or as Steve will talk about in a few moments, the private placement life insurance. Basically, it offers tax-deferred accumulations. The loans and surrenders provide tax-free distributions that never have to be repaid as long as the policy survives the insured. Again, there are minimal reporting or administrative requirements involved. The ability to discriminate amongst employees is there. An individual can do this for a key employee as a deferred comp. Small business, many corporations provide some form of deferred comp for key executives. And don't forget, the key employee can also be the owner, the employer themselves. Example, individual 45 deposits $25,000 a year till age 65, 20-year period. In this particular example, I used a 5.86% return, and this is usually on some sort of a variable universal policy where a 5.86% is considered conservative. The individual purchases that $500,000 policy, but he's or she's doing this because from age 67 to age 82, that payout would provide a $77,596 payout each year. And that's as a result of loans and surrenders that, as I say, never have to be paid back as long as the policy survives the insured. So the individual starts out with a death benefit of 1.67 million. It decreases over the years as the income is taken out, starting at age 67. But at age 82, the death benefit is still 257. So if you do the math of 15 years at 77,000, it comes out to $1,160,000. There is no gain. There is no tax due on that 500 on that gain between the 500,000 and the 1,160,000. 660,000 is a tax-free gain. Plus, they've had the life covered, and they never pay a tax on that $660,000 gain. Private placement life insurance is basically similar to a variable universal, only in some cases you can add a 0 or 2. With PPLI, one can defer gains in any permanent policy, but PPLI has lower costs. PPLI charges no surrender fees. PPLI is significantly more flexible, as you'll hear in a moment, and PPLI has more tax-efficient investment options than does a retail policy. At death, that benefit can pass income and estate tax-free to the beneficiary. And as a security, there are some, full disclosure, as a security, there are some legal costs to set up such a plan, but the costs are well worth it for the right individual. Most of the stuff that I've spoken about today can be looked at in a book that I was privileged to co-author for the American Bar Association, The Advisor and Trustee's Guide to Managing Risk. As Barry mentioned a little while ago, there are some handouts. I think it would be a good idea to take a look at them. And as far as my information is concerned, if anyone has any questions, obviously, please feel free to give a call or an email, and I'll be more than happy to entertain and answer any questions that you might have.